Hello, greetings. Welcome to Dividend Blasters. This is our 115th video. Our topic today is stack cash every single week crypto style. I'm talking about none other than that crypto focus income paying, weekly income paying ETF blocks. So, yes, I'm doing another video on blocks. Why am I doing another video on blocks? I just did one a few weeks ago. Um, tell you why. The reason why is that first video was really more of a primer. Um, what I've been doing over the last few weeks, I've been building my holdings in blocks. I like this ETF. I think that they do a very good job of having consistent distributions weekly, uh, and they do a really good job of growing the fund. And they do that because they do not tolerate NAV erosion. So they got me. I have been building my holdings, and what I want to do is I want to give you an update, a couple things. I want to tell you about the newly announced distribution that's going to be paid out on Monday, November 10th. I'm also going to talk a little bit about how these distributions can change. They can fluctuate as they do on all income-based ETFs. And I'm also going to give you a little bit more detail on the underlying holdings of blocks so you can understand what drives this really impressive income paying ETF. So, first, a little housekeeping. What I say is not advice. This video is for information and education. It reflects my own opinions, research, and experience as an independent investor for more than 30 years. So, do your own research and due diligence before making any investment decision. So I did cover this in the previous video, and I recommend if you haven't seen it, go back and look at video 112. I offer really a good grounding on blocks, and I got a lot of good feedback from listeners. They thought it was very comprehensive, not too long, but they have offered the right amount of detail, give them a good understanding of how this ETF operates. But in a thumbnail here, there's a couple of objectives. This, first and foremost, is an income paying ETF. It pays weekly, but their primary objective is capital appreciation, it's growth. They want to grow that fund. Um, the secondary objective is having that consistent income. They have that weekly distribution coming out. So I find that to be fascinating. This is an income paying ETF, but their primary objective is growth of the fund. When I read that and I hear that, that tells me one thing. That one thing is this, that they hate NAV erosion and they will not tolerate NAV erosion. And I love that because if you've listened to my videos in the past, you know that I do not like NAV erosion. When I invest in uh, anything, but let's just say if I'm investing in a covered call ETF or an income paying ETF, uh, I want that fund to be growing. I do not want to necessarily get a regular payment, a distribution, at the expense of the NAV. All right, no NAV erosion. And these guys are doing a really good job. Their approach, their methodology, their philosophy is in line with that. That's why I like blocks. And then also, and as you know, this is not your traditional crypto spot ETF that relies solely on performance in the market. This has a whole income dimension, and there are others in the market. There are a few good ones. I like the one by Neos, BTCI. But that's a little bit different. This one is more focused on growth. That one's more focused on income. They also do a very good job of no NAV erosion. And then there are quite a few others that are not necessarily ones that I would invest in, the ones that are income paying. The spot ones are good, and we need those because they do something different. So anyway, what these guys, they generate income, they replicate performance in some fashion, but they balance that income generation, not at the expense of the NAV. They want to make sure that the NAV is growing. So their allocation is very simple. Think of it as having really three sleeves. We're showing two of them here. The crypto sleeve, and this is what they call them. I got this from their website. The crypto sleeve is that exposure to those digital assets, and they're getting exposure, and by extension, we're getting that exposure through ETFs. So they hold three spot ETFs in the portfolio that give them and us exposure to Bitcoin and Ether. So 40% of the 50 is to Bitcoin and 10% of that 50 is to Ether. It's the crypto sleeve. The equity sleeve is different. The equity sleeve consists of several private companies, stocks, or publicly traded companies, stocks that they hold that are in the blockchain space, the crypto space. So you're looking at, for instance, cryptocurrency mining companies, uh, crypto exchange companies. There's also a few chip companies that are in there, and chip companies are very important. And I'm going to do a little deeper dive in just a bit on what some of those holdings are. So this here basically, I already talked about the ETFs and the equities. Um, Let me talk a little bit about the options overlay. This is the options overlay. Basically, is the way that they're generating premiums to distribute to us weekly, and it's going to be consisting of uh, cover calls and cash secured puts against these companies um, in the equity sleeve to generate income. They're also entering into these options contracts and selling these calls and puts to manage any kind of risk. And the digital assets by themselves are volatile. Um, we know that they're very volatile in a good sense, and that there's money to be made. But they also can have downturns as well. So that's basically why they're you know entering these contracts, not just to generate those premiums to distribute to, but to manage risk. And it can get quite complicated, but they definitely have a talent for that. Let's talk about income. I haven't really talked about this, but they have stated that they target around 36% distribution uh, for us to investors, and that they want to pay that out weekly. So typically, the cadence is this: they'll make an announcement on a Thursday. They'll say, "Hey, our next distribution will be the following Monday," and they'll announce it on Thursday. You can go to their website. I actually got an email from them because I subscribe to updates on blocks, um, and they basically target around 36%. But what they're doing here, which I think is very smart, is they're giving themselves some flexibility. They're basically saying, we're going to shoot for around between 30 and 40%. Uh, so, like on a weekly basis, that could vary a little bit. So, it may not be necessarily 36, but it seems to me like they've been doing 36. But why is that smart? Because there are a bunch of variables here that we're dealing with. The volatility of the digital assets, Bitcoin and Ether, but also the volatility of what's going on with the ETFs. And those are a direct reflection of those digital assets. And even little bit more removed indirectly are those equities that are in the blockchain space and in the cryptocurrency mining space and in the trading space, the exchanges. There's some volatility there as well. It's really a ripple effect. So, if you go back to their objectives are this: we want growth. That's number one. Number two is consistent income. And so they are prioritizing growth. And so think of a stool. You got a three-legged stool. You got to move things around a little bit to keep things in balance. So you may need to adjust the length of one leg versus another to keep the stool upright sometimes because things change. There's market conditions change, the performance of those digital assets change, the performance of the ETFs and the equities in the stock market can change. So they need to be flexible. And I think that is smart because all too often I've seen ETFs that are basically putting themselves in a very tough position. where they're basically saying, we are going to pay out this X% distribution every month. Um, and when they do that, they're putting themselves in a tough position because, like I said, there are a lot of variables that Nicholas Wealth or any investment firm cannot control. So they're giving themselves a little wiggle room, a little bit of leeway to prioritize growth and then generate that income. And let's be honest, these guys aren't generating income for investors quarterly. They're not doing it monthly. They're doing it weekly. There is no other income based ETF that does it this way. There are some other weekly payers, but these guys prioritize growth. No one else does that. And I think that is impressive. So we have to allow them some latitude to do that. All right. They do not have custody of digital assets. Um, the ETF companies, some do, some don't. Fidelity does. BlackRock does not. BlackRock has a separate custodian that holds on to those assets. Um, Nicholas Wealth, their focus is this: it's growing the fund blocks as well as distributing weekly to the customers and trying to get within that range and close to 36%. And could be above, could be below, but there's that little bit of latitude there. And that's really their focus and where it needs to be. Here's just a smattering of some of the companies in the equity sleeve, and I'll show you a more detailed list. But Tesla, and it's more than an auto company. It's a technology company. It's a data company. Coinbase, the crypto exchange company. Um, Robinhood, which is a full-fledged financial exchange, and you can buy and sell stocks and ETFs. But interestingly, you can trade cryptocurrencies. You can trade Bitcoin and Ether on that. NVIDIA, which has been at the epicenter of the IA revolution. They are the premier GPU chip designer on the planet. And of course, strategy. And you'll see the little Bitcoin logo at the end of their logo. And they were primarily for many years as a very good IT company, but we really know them today. And their leader, Michael Saylor, the executive chairman of the company and one of the founders. We know, he's a Bitcoin evangelist, but we know strategy essentially as a company that is focused on acquiring Bitcoin and adding it to their balance sheet. And they're a very big holder, um, not as big as like a BlackRock, but they're very big, and especially for what they do and how they've evolved. It's a fascinating story. So those are just some of the companies. And before I go on, I just want to say a couple things about Bitcoin and uh, Ether. These are really the underlying assets here, the digital assets. They are more volatile than any stock or ETF you can buy, but there's opportunities there. And by far, they have generated the greatest total return um, in history. So Bitcoin was started back in 2009, and their inception to date total return is 119 million plus percent. That is absolutely astronomical. That's like in a different galaxy. Pales Ethereum. Ethereum is only 473,000%, which is huge. That kills everything else. So just to give you some magnitude and some contextual understanding, uh, you can see the S&P 500 since 1995, and I'm going back 30 years. Total return 1,046%. The Nasdaq 100 about 4,075%. And those are very respectable. Those are great returns. Why am I telling you this? For this reason: if you ignore Bitcoin and uh, Ether, you do that really at your own peril in your investing journey. You need to have exposure to these assets in one fashion or another. I actually, um, so here's a disclosure. I own blocks. I own this ETF. I want to say 3,300 shares, 3,100 shares, I think it is, something like that. And I'm building that. I also own BTCI from Neos. It's a few hundred shares of that. I also own in a self-directed IRA Bitcoin. I have quite a few Bitcoin, and I bought in several years ago. I have even more Ethereum in that same self-directed IRA. So I have a lot of exposure to these. Now, is that the only thing I invest in? No, I have a ton of stocks and ETFs across the portfolio. I've been doing this for more than 30 years. But I pay attention, and I know when I see outsized returns like this, I'm going to get in and I'm going to be a part of it. And so, however you get your exposure, uh, and I think blocks is a decent way to get that exposure. And I've also mentioned BTCI; they do different things, and there's a couple of spot ETFs that you can look at as well. And that's another video. We can talk about that later. And this is just what I said graphically. You can see the inception to date return of Bitcoin. It everything else looks like it's flatlined. Going back to 1995. All right. So this is the announcement that I received on Thursday, November 6th, basically telling me that, hey, we're going to be doing our next distribution on Monday, November 10th. It's going to be 16.28 cents per share. You see that they basically have this, quote, 36% distribution rate. So that's kind of where they are. They're kind of saying this is it. But again, they're going to give themselves some flexibility, and they have to, because there's a lot of unknowns that I mentioned. There's some variables, and also they're doing this weekly, so they need to have that latitude, and that's perfectly fine with me. For historical purposes, you can see that going back to late August, what the weekly distributions have been in the far right column. So the previous week is 18.45%. So this one came down about 2.17 cents from 18.45 cents. Previous week before that, 17.43. Previous week before that, 18.09. Before that, 18.41. So these things, they fluctuate a little bit. And what you see here is really no different than what happens in any other income-based ETF. They're going to fluctuate. You're not going to see a steady growing distribution like you would with a dividend growth ETF like a SCHD or a VYM, because this is a different animal. They're generating premiums for you through options activity, through their options overlay. Best case scenario, best case scenario is this: the underlying assets perform perfectly every single day, and the investment firm wins every single options trade. There are no assignments. That doesn't happen. When you're selling these options, you're going to win on average, if you know what you're doing, 75, 80%. And maybe they're winning more. But 75, 80% of those trades, when you're buying these options, you're going to win the rest, maybe 20, 25%. And this is a very good team. So they're going to win a lot of them, but they can't control the underlying performance of the digital assets, the equities, or the ETFs. So there's going to be a little bit of that fluctuation. But the good thing is this: there haven't been any drastic fluctuations. They've been fairly gentle, which is a very good thing. And by extension, it makes the distributions fairly predictable. So I kind of talked about this, that these distributions, they do fluctuate. And, it's really, the bulk of it is the option overlay, the selling of these options. There may be some dividends buried in there. So I do know that a couple of the companies, Taiwan Semiconductor and NVIDIA, they both pay dividends, but NVIDIA's is very small. Taiwan Semis is a little bit better, but it's small. The bulk of the distribution that you're getting are coming from the options trades. I already talked about the dependence on market conditions as well. These are volatile assets. So, volatility can be a good thing, but it can be a challenge for these guys. They have to adjust their options trading strategy appropriately. Now, there is no guarantee of a distribution. Okay, they may basically have to have some flexibility. on that distribution. I already talked about that because their priority is growth. So that could change. I don't see them canceling a distribution. I really don't. Could happen. I mean, nothing's guaranteed in life, but I don't see that happening. But I do see the possibility where they need some flexibility. And, they may actually have to vary the percentage. I don't know if that's going to happen. It could. So, in summary, any shrink in the distribution like we see for this Monday, it's really the result of really normal fluctuations and the whole options trading game, as well as the performance of those digital assets and the equities and ETFs. So it's not unusual. It happens. Here, just for your own understanding, is a list of some of the key holdings here. Shaded in orange are the three ETFs, and these are the largest holdings. HODL by VanEck, and it's all Bitcoin. FBTC is by Fidelity. That's really more Bitcoin. And the last one is BlackRock's iShares, Ethereum Trust. It's ETHA. So remember, within that crypto sleeve, it's 50%, 40% is Bitcoin, 10% is ETHA. Then the equity sleeve, which are the companies, also 50% is comprised of these listed in blue. Iron, Cipher, Hut 8, those are all mining companies. Hood or Robinhood, that is the financial exchange where you can buy and sell stocks and ETF, but you can also trade cryptocurrencies, which is something that a lot of exchanges don't do. Keep an eye on Robinhood. They're big, and they've gotten big quick, and they're going to get bigger. I will just tell you, for disclosure purposes, I own shares in Iron, Cipher Mining, and Robinhood. Next one is Galaxy Digital. That's another mining company. Riot Platforms, I own shares in that. And then we have our chip companies, Taiwan Semi and NVIDIA. And then we have a full-fledged crypto exchange, Coinbase. Coinbase has grown quite a bit over the last few years. Mara Holdings, which used to be known as, no, that was something else. It's always been Mara Holdings. That's another mining company. And then, of course, Michael Saylor's company, Strategy. Then they have a cash position, and you need to have cash to support cash secured puts. They have some treasury securities, and I see CoreWeave, which is an infrastructure company, and they work closely with NVIDIA. Then we have a couple more mining companies. And then the rest of these are primarily the contracts, the options contracts. I'm not going to read these. There's 2 slides, but they're all calls and puts, and they're there to generate that premium income for distribution purposes, but also to manage any potential volatility risk. So let's talk a little bit about BLOX. Excuse me. It's performance, price, and total year to date. Dig a little deeper. So if you look at the year to date price return, it's about 19.72%, a little bit under 20%, about 5 percentage points more than the S&P 500. It's just the price return of BLOX. Total return, it jumps to 35.5%. So that's about another 16 points. It's coming directly from that options overlay strategy. And that makes a difference. And if you think about that, their total return is actually a little bit more growth than it is income. So they truly do practice what they preach. Their priority is growth. Their secondary priority is income. Now, the last 1 month has been a little bit more choppy. The market has been a little bit more volatile. And this industry sector, particularly around the blockchain and crypto in that area, has been a little bit more volatile. And some of the underlying holdings have been getting beat up a little bit. And we see that essentially carry through towards BLOX. So in the last month, BLOX has returned a price return of about minus 16%. So they are a little bit below. The S&P 500 is down a little bit, minus 0.29%. And I'm going to show you what some of those holdings are and how they've been impacted. But what's interesting is that's just the price return. When you look at the total return, it softens it a little bit. It's still negative. It's minus 12.74% for the last month. But that is a little bit better than the minus 16% price return. So let's take a look at some of these holdings. And let's take a look at the ETFs. So HODL, FBTC, and ETHA. HODL and FBTC are more Bitcoin invested. So you're talking about 8% price return year to date. That's the year to date. The BlackRock one, ETHA, that is a Ethereum ETF that's a little bit to the negative minus 1%. That's price return year to date. Let's look at total return year to date. It's going to be identical. These spot ETFs do not pay any kind of a distribution or a dividend. It's totally price replication in the market. So the numbers are exactly the same. Let's look at the 1 month time frame for these ETFs. Now, you remember what I said was that BLOX has been a little bit negative in the last month. Why is that? Because Bitcoin and Ethereum have had some negative volatility over the last couple of weeks within this past month. So HODL is almost minus 20%. The Fidelity one is almost the same. It's same thing, actually, minus 19.64%. The Ethereum one is actually down a little bit more, minus 30%. That's price return. Market return will be identical. So those are the ETFs, and that's the exposure to those digital assets. Now we're going to talk about the equity sleeve, or the companies that give you exposure to the performance of activities in the blockchain space, the crypto mining space, the crypto trading space. We're going to look at a few of these companies. So IREN has performed phenomenally year to date, almost 582%. Cipher Mining, almost 368%. Hut 8, almost 112%. Hood, 241%. Galaxy, 68%. And Riot, 69, almost 70%. Full disclosure, I own several shares of IREN and Cipher. I own a few shares of Robinhood, and I own several shares of Riot Platforms. So year to date, they've done really, really well, particularly IREN and Cipher and Robinhood is doing really well. I'd be very happy with a 68 or 69% price return year to date. I'm absolutely ecstatic with IREN and Cipher. And Robinhood too. Okay, so let's look at some more. Taiwan Semi, NVIDIA, Coinbase, Mara Holdings, Strategy, and CoreWeave. The chip companies are in the 40s. Taiwan Semi, 46%. NVIDIA, 40%. Coinbase, a little under 19%. Mara Holdings is negative, almost minus 5%. Strategy, down 18%. And CoreWeave has done really, really well, 167%. That's price return. You're not going to see much difference with the total return. You'll see maybe a tiny difference with Taiwan Semi and NVIDIA, but really the rest of these are all going to be essentially the same. So total return, again, 582 for IREN, Cipher, 368. So it's really going to be essentially the same. I'm not going to read them all. I'm making the point here. Taiwan Semi, year-to-date total return, 48%. NVIDIA, 40%. NVIDIA's dividend is so tiny, it's almost non-existent. Taiwan Semis is a little bit better. The rest of these do not pay a dividend, so going to be identical to the price return. So now let's look at 1 month. 1 month is going to be a little bit choppier, just like we saw with those ETFs. So 1 month price return, IREN, down, a little below 16%. Cipher, a little bit better, but not as good as it was for the year to date, obviously. It's 41.5%. Year to date, it was like 367. IREN was like 582, so much less. Still performing really well, but much less than what we saw year to date. Hut 8, 4.71%. Hood down 12%. Galaxy down 22%, and Riot down 20%. So, things have been a little bit more choppy for the last month for companies in the blockchain crypto space. Uh, Taiwan Semi is down last month. Price return -4%. Nvidia 1%, still above zero, but for last month much less than the 40% we saw year to date. Coinbase negative 23%. Mara Holdings -22%. Strategy -34%. CoreWeave, which we saw year to date was 167, is now -20% for the month. Looking at total return, you're really going to see no difference here. You'll see a tiny bump up with, none of these. With Taiwan Semi, and that's the next slide, as well as NVIDIA, very tiny. Here, these are going to be identical to what we saw with price return. Taiwan Semis is up just a tiny bit because of the dividend, but not much. Nvidia's is really about the same because their dividend is so small. Everything else is identical. So I made my point here that there's a couple of points here. The total return, where there is ever any kind of an income component, it softens market volatility in your investment. That's one thing. And then really more specific here to this industry sector, what we're seeing is year to date, the performance has been better overall, but the last month has been a little bit more challenging. So why do we see this slight decrease with BLOX distribution? It's really a couple of things. It's the result of normal weekly fluctuations with any income-based ETF, but also there's been a little bit of choppiness in the market with those digital assets, Bitcoin and Ether, as well as the companies that are in the space. And quite frankly, that small, fluctuation downward with this distribution is tiny. I was actually thinking, hey, maybe they're going to reduce it more than what we saw. So I actually commend them on that. And these things are not unusual. And as I mentioned, with any income-based ETF, you're going to see this fluctuation. So let's talk a little bit about what I'm doing here with BLOX. I've been investing in this for a few weeks. I've been building my holdings, been building them quickly. I got over 3,100 shares across a couple of accounts. I have about 3,067 shares in a Schwab account. I have 43 and a half shares in a Fidelity account. These will all go up a little bit as I drip on Monday, but also as I continue to drip in the future. I do not have my auto drip on. I could change my mind on Monday and say, I'm going to take some of this and reallocate to a couple of other stocks or ETFs, or maybe take some cash and go out and have some dinner, or pay a couple bills. I could do that. But if I do drip, I'd be actually looking at dripping $505 in weekly distributions, which will come to about 22 shares a week. So, let's just say, let's say I don't add any more cash into this ETF, but I do drip. I could continually drip 500, but the amount would go up as the holdings go up. And if the distribution rate remains about the same, I can see $500 a week, but it will go up at some point. Past 12 months, I will be dripping at least $24,000 for basically dripping if I decide to drip. Now, if I add more funding into this, I can certainly accelerate that. And here, this is really what we're talking about when we talk about a dividend snowball, a snowballing effect. So as the asset base grows, the NAV is stable, but it continues to grow. The base is expanding, so that distribution is going to be drawing from a greater base, a growing base. So you're going to get more weekly. You can drip more and continue to grow the base. So, folks, that is it. And you know, as I said at the beginning, I'm going to be doing a periodic video on blocks just to give you a status, talk about what blocks is doing, and also how my journey is going as I continue to build my holdings. And I think a very good, impressive ETF. So, folks, that's it. I thank you for sticking with me. I hope you found this video to be informative and enjoyable. And if you did, give us a like. We love likes. Share the video with a friend. Hit that notification bell. So every time we here at Dividend Blasters release a new video, you will be notified. And we would love, love, love for you to subscribe to this channel, Dividend Blasters. Check us out on other platforms. You can see the QR codes and handles below. We are on X, Instagram, as well as Facebook. And as a friendly reminder, if you've listened to me before, you do know that in addition to being a longtime subscriber to Seeking Alpha, I am also an affiliate partner, and I can extend discounts to you with the following links to their premium membership and alpha picks. Premium membership is phenomenal. I love to have that insightful analysis along with those up-to-date stock and ETF quotes. And you know what? You go ahead and consider subscribing. You're going to get a 7-day free trial after 6 days. If you don't like it, you can cancel. No harm, no foul. You can get a $30 discount, an introductory discount off the regular price. Alpha picks, you're going to get 2 free picks every month by their team, as well as their quant team, essentially. That's what I'm trying to say here. I love alpha picks. I get 2 wonderful picks every single month, which absolutely kill the S&P 500. And you will get, I want to say, a $50 discount for introductory subscriptions. If you want both, and I have both, that's equivalent to the bundle, you'll get $159 off. You can check out the links below as well as the QR codes. A little bit more of the same here. I already mentioned we're on other platforms. And folks, until our next video, have a wonderful day. God bless.